Network's webinar series featuring TRITEC Americas. Presenting for us today is David TRITEC, President, Managing Director, and affiliate of TRITEC Group with offices throughout Europe, South America, and the US. Since 2006, David has been a leader in the solar PV project development, finance, and asset management industry. Over the past decade and a half, David has developed and implemented cutting-edge finance and investment structures to help TRITEC's investment partners realize safe, stable return while significantly mitigating their tax liabilities and helping the environment by increasing renewable energy's impact on climate change. At the end of today's presentation, we will have time for Q&A. Please use your questions chat option on your screen to send over any questions you have so David can answer them accordingly. And with that said, David, I'm going to let you take it from here.
Great. Thanks so much. Thanks, everybody, for joining in. I have a brief presentation to kind of walk everybody through our program and how it may help individuals or family offices mitigate tax liabilities and also invest safely in renewable energy. And so with that, I'll get started. I understand that it's not an interactive original presentation. At the end, we'll be answering questions, so I'll just make my way through and look forward to answering your questions at the end. So again, my name is David TRITEC. I'm President and Managing Director of TRITEC Americas. And we're going to discuss our commercial and industrial solar investment opportunity. If you end up getting a copy of this presentation down the road, we just ask that you sign the confidentiality agreement, and that's on page 2. Again, I won't go through and read the presentation to you. I'll give you an overview, but essentially solar projects investments are driven in large part by tax benefits. The tax benefits are twofold. One is an investment tax credit, which is a federal investment tax credit, which basically states for every dollar you invest in a renewable energy project, you will get a tax credit of a certain percent. Today, the tax credit sits at 26%. So for every dollar you invest, you'll get 26 cents of tax credit. That's as cash. So if you owed 26 cents on your taxes and you invested $1, you would owe 0. In addition to the investment tax credit, there is bonus accelerated depreciation for solar projects. That is 100% bonus accelerated depreciation in the first year of the investment once it's placed in service. The only reduction to that is 50% of the tax credit. So in the current environment with the 26% tax credit, you would get 87% of your investment depreciated in the first year. And we have an example further in the presentation where I can show you how those numbers work. There's some summary and some narrative on this page here that if you want the more detail after the program, you can certainly look into it. What's nice about our fund is that it's a very quick return of capital through the depreciation, the federal tax credit, and obviously the project returns. It allows investors to diversify and balance their investment portfolio because a majority of the short-term gains comes from the federal government and state government vis-a-vis your tax liability. So it's very safe, it's proven, and then long-term you have a solar project in your portfolio that produces long-term healthy returns that are very low risk. A little bit about TRITEC Americas. TRITEC Americas is the Americas affiliate of TRITEC Group. TRITEC Group was formed in 1987 in Basel, Switzerland by my business partner, Giorgio Hefti. So I'm not sure how much people know about solar on the call, but in 1987, it was a real nascent industry, and Giorgio was literally installing the very first systems in Europe. So a true solar pioneer, engineer by trade, and he grew TRITEC Group throughout Europe in the 90s and 2000s, opening offices in 15 countries throughout Europe and South Africa. In 2012, he and I formed TRITEC Americas, and in the Americas, we have offices in São Paulo, Brazil, Santiago de Chile, and in San Diego, California. Out of the San Diego office, all we do is commercial and industrial, project development, finance, and asset management. Commercial and industrial is really defined by size. It's non-residential, between 50 kilowatts, which I can explain in a second what that means, up to 10 to 20 megawatts. A typical home will have 6 to 10 kilowatts to run that home. So 50 kilowatts would be about 7 or 8 homes, up to 10 megawatts, which may be 70,000 or 80,000 homes. So that gives you a range of sizes of projects that we participate in. In other offices throughout the world, TRITEC distributes solar energy products. They install and do asset management and operations and maintenance, and also project development throughout the world. But in the U.S., we focus solely on project development, finance, and asset management. So our main principles of the company, we just went over Giorgio, who, again, since 1987, has been leading TRITEC Group. TRITEC Group has deployed over 1.2 gigawatts of installed capacity throughout Europe, South Africa, South America, and the U.S. over the last 33 years. Then myself, you got a little bit of introduction to me, but I'll give you a little bit further background. I started in solar in 2006 on a residential third-party solar platform, third-party ownership solar platform. And third-party ownership is defined as there's a host customer, whether it's a homeowner or a business, but a third party owns and operates that system. And that owner is the one that's capable of receiving the tax benefits. In addition to this residential third-party ownership, we develop proprietary building integrated solar products for roofing and other building materials. And we rolled out a roofer-centric solar finance program. And in the program, we rolled out to over 3,000 residential homes and HOAs throughout that time. Since 2012, my focus has been on commercial solar, and over the last 8 years, we've deployed about 196 megawatts of commercial solar projects. I attended the University of Michigan in Ann Arbor, and prior to entering renewables in 2006, I was in the development and construction industry, which provides nice background for the solar industry because construction is a big part of the solar industry. We also have Howie Reed on our team, who has over 11 years now of direct solar operational experience, managing operations and sales teams, and he's in charge of all of our technology, our channel partners, our sales, and our operations and maintenance departments. One of the questions that gets asked a lot is, how big is the solar market? And specifically, how big is the C&I solar market? And the short answer is it's almost unlimited, because it's only limited by capital. If you look at the solar industry and how it's penetrated the market, especially in what we call the C&I space, you'll see that it's very, very low single-digit or less than single-digit percentage penetration. However, when you think of all the rooftops, if you've ever flown into Los Angeles or into larger cities and just seen literally the sea of white rooftops out there. All of those roofs are fertile ground for solar development. Parking lots as well, empty fields. And so the solar market, we believe on an annual basis, if you were able to really monetize it with enough capital, is 382 gigawatts, which is, it's almost an inconceivably large number. So the market is about acquiring customers and finding the right investment partners who have the tax liability that can monetize the tax benefits and do it in an efficient way. And so this market, this 382 gigawatts, is this 50 kilowatts to 10 megawatt system size. Obviously, there's the utility scale market, which most of you have probably seen, big solar farms that are over 20 megawatts. That does not include that market. This is just what we call the C&I market. What's happening in the commercial and industrial solar industry is that there's a big shift to third-party ownership. So back in 2010, when I was still doing residential, a larger percentage of projects were owned by what we call the host or the off-taker, or the business, for lack of a better word. But as time went on and the structure of the commercial solar finance deals was refined and made more efficient, more and more projects reach a third-party ownership structure. And now you can see it's almost 2.5 or 3 times more projects now are third-party owned versus what they were 10 years ago. Along the same lines, in the residential, when I started in 2006, 0% were third-party owned. They were all owned by the homeowner. By the time in 2012, when I started in commercial, 90% of solar projects were third-party owned. And we see the same trend going in the commercial industry. What limited the commercial industry to such a rapid comparison to residential, where residential over 6 years went from 0 to 90, were simply transaction costs, because there were larger transactions, the documents weren't standardized, like your car lease is standardized or your home mortgage is standardized. So we worked very hard in the early years to standardize documentation to allow for a much more efficient transaction and really lower the cost of the transaction, so that it opened up the market to more possible customers. So why TRITEC Americas? We have this space approach, and so we say scalability, profitability, automation, consistency, and efficiency. And this goes back to our 33 years of strictly solar experience, learning from the very early days how to develop, build, and maintain and manage projects, and then bringing on financing at a later date. And so we're very uniquely qualified, not only just our number of years in the industry, which is really unrivaled, but also the type of projects we do and how we overlay our experience with our strategic partners to bring projects to fruition. Speaking of strategic partners, we have created a strategic partnership with Swinnerton Renewable Energy. For those of you who know about solar, I'm sure you've heard of Swinnerton. They are the largest EPC contractor in the country, consistently the largest. EPC stands for Engineering, Procurement, and Construction. It's essentially a solar general contractor. And Swinnerton was founded in 1888, and that's a real date, 132 years ago. They have California license number 92. Obviously, in 1888, they weren't doing solar. And in 2007, when the economic downturn hit, they pivoted and created a renewable energy division that has since grown into the largest renewable energy construction company in the country. In 2019, they generated over $6 billion with a B in revenue. They have over 2,400 employees. And additionally, they have a division of their company called Solve, which is their operations and maintenance division. And currently they have over 6 gigawatts of projects under operations and maintenance contracts, which makes them the largest O&M, which is short for operations and maintenance, provider in the country. They're located here in San Diego County, about 12 miles as the crow flies from TRITEC Americas office. They have a NOC center, which is a National Operations Center, right here in San Diego, and it's a pretty cool operations center. It's Department of Energy sanctioned, so there's actually 2 or 3 airlock vestibules, and only a certain number of people can actually get into the NOC center because they are operating and maintaining government projects as well as utility projects. And so you need a very high level of security to actually get in there, but you can look through, and it looks like a NASA ground control center. Hundreds and hundreds of flat panel screens, every one of their projects on a pin, reporting in real time how the project's operating, if there are any issues or there are any warnings with respect to production of the system or anything that needs attention. So that's how they manage the systems for us, and they provide oversight on our construction, and they provide our ongoing operations and maintenance and a production guarantee, so that we have this giant company standing behind all of our projects telling us it's going to produce what we say it's going to produce, or we're going to stand behind it, whether it be rolling trucks to get it up or, in fact, even compensating for underproduction. So it really creates an investment that's extremely safe for the investor. Here's just a few typical featured projects that we develop and that you may participate in, type of projects down the road. TRITEC Americas is the exclusive PPA provider for the San Diego Diocese, and we started that program with them in 2015, and they have 140 properties throughout San Diego County, and I think we've solarized about 75 of them. One of them is their sort of flagship high school called Cathedral Catholic here in San Diego. It's a 1.15 megawatt system, all carports, and a carport is essentially a structure where the solar goes on top and provides shade and protection from the elements for the cars below. It's all lighted, and they're really nice amenity for a parking lot. And a lot of our business and school clients, they're going towards carports because they like the amenity, especially in Southern California, where the cars get very hot from the sun. In that particular project, they're going to, the investor has a payback of 1.1 years on a $3.6 million investment through the tax benefits and some leverage that we placed on the project. And you can see the IRR on a levered basis in this project was 26.96%. I won't go through all the details of the numbers on each project, but I'll explain each project that's on the sheet. The next one is an irrigation district, which is a quasi-government agency. In California, there's irrigation districts that serve farms and communities, and the way they do that is by pumping water, so their electricity bills are very high. And in this case, it was a little over a megawatt, and you can see what the payback and the IRR. The last one on this particular page is a portfolio of projects for a school district in Imperial Valley, out in the desert near Palm Springs, called Coachella Valley Unified School District. It was 18 sites, almost 10 megawatts, a $37 million investment, and the power, what we call the avoided cost of energy out in the Coachella Valley is very low. So the PPA rate's a little bit lower, so you can see a little lower IRR on that particular project. And your IRRs will be dependent on essentially 4 factors. Cost of the system, so carports cost more than the ground mounts you see there. How much solar energy can be harnessed in that particular location. So in California, it's going to be more than it will be in New York. Any incentives that are there, okay? And also what the avoided cost of energy is, because we generally only do our contracts, which are called PPAs, power purchase agreements, is if the customer is saving at least 10% in the first year. So if their avoided cost of energy in Southern California, in San Diego, is 20 cents a kilowatt hour, then we want to make sure that their PPA rate is not more than 18 cents in the first year. Conversely, out in Coachella Valley, it may only be a 12-cent avoided cost. So we have to be in the 10.5-cent range to meet our underwriting requirements. So you can see that the revenue will be lower out there, but the production's much higher in the desert than it may be in the coast. So there's a lot of levers that get pulled on the project, and each project is bespoke. So there's not one particular return, rate, payback period, leverage amount that gets sort of amplified. It's every project within itself, and this way, when we are looking with our investors and they say, here's our tax situation, here's how much we're trying to avoid, here's what we have available to invest, then we match that investor's needs with a specific project, as opposed to just a lot of funds. They just collect the money, they put it out, and the investor gets a share of their percentage in the fund. As I'll explain later on, ours is more bespoke. As we go on, we're constantly growing, which is great not only for our company, of course, but also for the environment and the industry. In 2019, we deployed about 45 megawatts, and in 2020, we're on pace for about 105 megawatts, and our pipeline currently is 350 megawatts, of which we think in 2021 we'll realize about 200 megawatts of that. And so we have two sides of our sort of business development. One is getting projects. The other is what I'm doing right now, which is essentially raising money. And so we've created a very efficient financing structure. We rapidly deploy the capital, and we've matched it with non-recourse debt. Our channel relationships are very strong. So whether we're in the agricultural business, or as I said, the diocese, or school districts, or manufacturing, we not only do one-off projects, of course, but we also like to focus on what we call channels. So large multinational companies that have multiple locations throughout the U.S. that we sign development agreements with them, and when we look at their entire portfolio. We also follow it up and back it up our technology platform, which is in the background, that allows all of our channel partners, EPCs, which I said, again, we're construction companies, or what we call originators, or our internal salespeople. They're in our technology platform in the background, which allows us to scale very quickly and deploy projects both efficiently and with high returns and very safe. Here's a typical investment summary to give a quick overview. There's a lot of words on this page, and so I'll summarize. This is a municipal/utility project in Connecticut. So we have two sources of revenue for this particular project. It's a 5.3 megawatt project, or 5,380 kilowatt project. Remember, I said earlier 6 kilowatts is a typical house. So this would be equivalent to about 1,000 homes, something like that, roughly. It's up in Connecticut, and so we've engaged in, again, a PPA, power purchase agreement, you can see on the screen, with a local municipality that's investment grade. They agreed to buy all the power that the system produces for 20 years. In addition, there's an incentive in Connecticut called a ZREC. Z stands for the category or the size of the system, and REC stands for renewable energy credit. And so, as you can see on the right side there, we have a PPA rate and a ZREC rate. This particular investment is $18.5 million and change. You'll see the tax credit, as we talked about before, which again is a dollar for dollar offset your federal tax liability. It the tax credit can be carried back 1 year from the investment year or carried forward 20 years. So it's extremely valuable because it's a dollar for dollar reduction in your tax liability. Unlike depreciation, which is a reduction in your taxable income. So in this particular example, we showed the value of the depreciation, and that's based on a 37% tax bracket. So you would take that investment of $18 million and change, you'd reduce it by half of the ITC. In this case, the ITC is 30% because this is a project that is safe harbored. So the equipment used on the project benefits from a 30% tax investment tax credit. So you depreciate the investment by 15%, and then the rest is 100% depreciable in year one. Multiply that by 37% tax bracket, and you get a value of $7.1 million. This particular project is going to generate revenue of $1.3 million and change in year one through those two revenue sources, and the expenses to operate that system are almost $300,000. So this particular project is going to throw off $1,057,000 in year one, and over the 20 years, $16 million. If you don't apply leverage to that, after you apply your tax benefits, it's going to produce about an 18.5% unlevered IRR. What's unique about our program, and I think we talk about it a little bit down the road, but I'll still mention it here, is that a lot of times we pair non-recourse debt at what we call the project level, and all that is on the hook for that debt is that project. So it doesn't go back to the owners, it doesn't go back to the principals, it doesn't go back to the family office. It's just at the project level, which is great from a mitigating risk and liability standpoint, and it also provides for cash within 90 to 120 days of the project turning on. So in this case, if you look at the numbers, you have an $18.5 million investment. You're going to get the tax credit of $5.5 million. You're going to get that depreciation value of $7.1 million. And then if you want the non-recourse debt, not everybody does, because a lot of groups say, well, I'll take the 6.25% instead of paying it to the lender. Others to take that non-recourse debt and reinvest it. It just depends on everyone's unique circumstances. And again, that's why we do a bespoke investment approach. But in this particular case, if you invested $18 million, you're going to get back $19 million in change within 90 days of the system turning on, and then you're going to have cash flow for 20 years. So you can see what that does to the IRR. The levered IRR dramatically increases because you're getting all that non-recourse debt back, and just the project is paying it back. In a doomsday scenario where in this case, the city went bankrupt and the utility didn't pay its bill, you would already have had all your money back plus some return, and the lender would be the one seeking to recover that $7 million in this particular. Of course, we underwrite all of our projects, and we've never had a default on any of our projects. That's not to say projects don't default. C&I PPAs have a default rate of 0.1%. So very, very low, almost doesn't show up on the graph, but 0.1% of PPA projects over the term, and the average term is 20 years, will default. Very low rate, very safe and secure investment. Another thing we do is that we don't generally do a typical tax structure that maybe some of the people on the phone have heard about, which is called the tax equity flip. Our general structure is a single investor structure. And we made this change back in 2017 when the new tax law put into effect in October, because the corporate tax rate, what used to be 35%, and with the tax law change, it went down to 21%. So it reduced the value of the depreciation and the tax credit for a corporate investor, and essentially reduced their tax liability. So there was less money available for a typical tax equity investor, which back prior to 2017 in our structure would have been a bank or an insurance company or a fund of other corporations. And when their tax rate dropped from 35% to 21%, we made the choice to primarily change to a single investor structure with high net worth individuals or family offices, because their tax rate didn't drop and they could certainly benefit more, which would allow us to do more projects and be able to offer more PPAs to customers that otherwise wouldn't be able to save enough money, because in order to hit the hurdle rate on a 21% tax investor, the rate would have to be higher, the PPA rate would have to be higher. And so when you think about having a larger tax rate for the investor, it allows you to lower essentially the PPA rate and get more people into the funnel. And that's what we've done. So in our structure, the investor, you or your family office or your clients, will own 100% of the project. Each project gets put into an SPV, a special purpose vehicle, that owns all the assets of that project. So it owns the PPA contract, it owns the construction contract, it owns the O&M contract, and it owns the asset management contract. And that special purpose vehicle is what gets purchased or invested into by the investor. And then we, as TRITEC, we manage that project. We asset manage that project for you. And instead of owning a piece of the project, we take 10% of the net cash flows. And that allows our investors to have full autonomy and full authority without having to worry about partnerships or what they do, when they want to dispose of the project, sell, increase, whatever, put more leverage on, whatever they want to do. We're there to facilitate, but generally speaking, our investors own 100%. We do have structures where we just take in a tax investor. Our preferences are 100% single investor structure, but we do have projects that we do bring in just tax, where TRITEC is the sponsor, and we put the money in at the difference between what the tax investor puts in and what the project costs. TRITEC will sponsor that project. But generally speaking, this is our fund structure. It provides the most autonomy and authority for our investors and the most flexibility and certainly the highest return. So we're out in the market. As I said earlier, we're developing projects. We have a 355 megawatt pipeline. In 2021, we're hoping 200 megawatts of that gets begun, or notice to proceed is the term that we use in the industry. So we're out looking for investor partners. We could, right now in 2020, we could take up to another $150 million of investment, and then over the course of the next 18 months, up to $300 million of investment. And remember that our investments, they start out at the gross amount. So if you invest $10 million, that's what you're purchasing the project for. But if you use our unique and bespoke debt product, non-recourse debt product, then 30 to 60% of that money will come back in the form of non-recourse debt. And so if you invested $100 million or $10 million or $5 million, you would get between 40 and 60% of that back within 90 days of the operation of the system, and be able to reinvest that money or use it for other purposes. So I would say 70% of our investors use the non-recourse debt. So in that case, for every $1 million you invest, you're going to average about $500,000 out there before the tax benefits. And as I showed you earlier, the tax benefits more than cover that $500,000 of investment. So that's the presentation. I'm sure there's a bunch of questions. I'm happy to answer whatever you got.
Hey, David, thank you so much. Great job. Yeah, I think we should kind of just dive right into the questions because they are flowing in here. So first question, are there any California state income tax advantages?
Yes. So in California, instead of the 100% bonus depreciation in year one, the benefits come over 5 years through a maker's bonus depreciation, and it's not straight line over 5 years. I believe it goes 20% in year one, 32% in year two, 20 and 16 and 20. So, but yes, the full investment amount is depreciable in California, but it's over 5 years as opposed to in year one federal.
Okay, great. And kind of following on to that question, how long from day of investment to day of deductions and credits do you invest in 2020 or 2021 tax benefit?
So it's a great question. We're in November, so we have very few, if any, projects. I think maybe one or two that will be 2020 projects that are available for investment in 2020 that'll apply to your 2020 tax return. But most of the money that we are raising is for 2021 projects. So the availability of the tax credit is generally when the project is placed in service, meaning ready to be turned on. However, depending on your individual tax structure and what your accountants and advisors tell you, if you're making quarterly tax payments and you've already invested in solar, you know you're going to have a tax credit of a certain amount, you can immediately start offsetting your quarterly tax payments in that year. The depreciation has to come through the return of that SPV, which generally happens on January 1st of the following year. So a lot of it has to do with what time of the year you're investing, when the project's getting turned on. But what happens is we're out there developing projects and then essentially matching investors with projects. And so a lot of our projects, investors have already committed to projects that are coming on in June and July and August, because the ones in Q1 and Q2 are getting taken, because what inevitably happens in the early days of us doing this is everybody, of course, would like to invest on December 31st, have the system turned on December 31st, have the tax credit, have their money out for one day, have the tax credit for that whole year apply, and then the next day, January 1st, take the full depreciation. But that isn't the reality of how solar development works. And we really encourage our investor partners to plan ahead, make a commitment for a certain dollar amount for the year, and then as the projects come online, then they make the distribution or the funding of that. And that way they're not sitting in Q4 saying, geez, I have a huge tax bill and I have nothing to offset it because there's no projects left available. And I can promise you every day I get a call saying, please, is there anything you have available? And that's why I'm always really out front about this, that it's better to make an annual commitment. You probably know roughly what your tax liability is going to be for the fiscal year, and say, okay, if I owe $5 million to the IRS and another $1 million to the state, this is what I want to offset. So I'm going to commit this amount of funds for solar. I know I'm going to get it all back within 90 days after those projects are turned on. So I'm going to make that commitment, and then we come to you as the projects become available and say, okay, here's the project. It's a school. It's a business. You have the right to reject the project. You have the right to obviously do all your diligence, whatever you would do, all the financials of what we call the off-taker or the customer, look at the layout. You're not required to acquire any project. You have a certain amount of time to review it. If it's yes, it's yours. If it's no, no problem. We'll bring you the next one. We do a tremendous amount of pre-work on the underwriting to make sure we're only providing quality projects. So hopefully our experience and know-how and our team of underwriters, and we already know what the lender is going to approve. And the lender actually has stricter underwriting requirements than we do, because their debt is non-recourse, right? So they can't come to TRITEC. They can't come to you as the investor and say, hey, the customer's not paying the PPA, you need to pay the loan. So they have even stricter requirements of underwriting, and we know what they're going to approve, and we don't even present projects that can't be underwritten.
Okay, great. Thank you. Are your IRRs all calculated assuming the maximum federal tax rate?
All the ones I showed, we're talking about the ones I showed, they all assume 37%.
Okay, perfect. Frank, if we didn't answer your question all the way, please go ahead and chat more and we can get into greater detail. Next question.
Let me just say one thing real quick on that. I mean, we do have a lot of corporations, C corps, that invest. They only have a 21% tax bracket essentially, plus their state. So the IRRs drop because the tax benefits are worth a little less, but there's still amazing returns because, but for the solar investment, you're writing a check to the IRS. And so if you can write a check for a solar project as opposed to the IRS, that money is gone once it goes to the IRS, regardless of your tax bracket. And so if you can take those same exact dollars and invest them in a solar project and not only offset taxes you'd pay to the IRS in the state, but have long-term revenue, it really is a unique investment structure. Yes, if your tax bracket's lower, it's a little lower IRR, but they're still way above market and extremely safe because it's government risk essentially on the tax benefits.
Okay, perfect. Next question. If an investor wants to utilize leverage, do you have lenders that you can bring to the deal?
Yeah, the leverage is prearranged. So that's what makes our structure super unique, is that we have 4 or 5 lenders that we spent the last 6 years developing non-recourse debt that matches not only market rates and terms, but our non-recourse, which is the sort of the biggest hurdle that commercial projects had getting over, because it was tough in the early days when there weren't a lot of commercial solar projects for the lenders to get comfortable what the risk was. But as I mentioned, 0.1% of commercial and industrial PPAs default. So, I mean, that number is extremely low. And the reason is that we're providing power at a lower price than they're buying from the utility. So they would have to go to business in order for them to make the decision not to pay their bill, because if they don't pay our bill, they're going to have to buy their electricity from the utility at a higher rate. And so that's why you don't see a lot of commercial and industrial PPAs failing. But I don't think I answered the question 100%. The debt, when we present the project to you, we will already tell you what the debt is, what's available on that particular project, at what rate and at what term. And you can decide, do I want to take it or not want to take it? And we're gonna give you the best debt option in the analysis that we provide on the particular project. We usually provide a one sheet to start with that talks about who the off-taker is, what the rate is, the PPA rate, what it's going to cost to acquire the project, what it's going to cost to operate the project, and what debt's available. And then it gives you a levered and an unlevered horizon. We use a 6-year horizon, and I failed to mention something earlier that I'll say in a second, but we use a 6-year horizon on the IRR because the tax benefits, the only caveat to the tax benefits are you got to hold it for 5 years. So if you think of 60 months of the tax benefits, every month less than 60 if you sold the project in the 59th month, there would be a potential of a recapture of 1/60th of that depreciation. So we always model 6-year hold, because in the 6th year, you could sell the cash flows, the project, to somebody else, or you keep it. It just depends. But we show both IRRs in a year 6 sale with a certain discount rate and also the whole term of the PPA.
Okay, perfect. And actually, next question, a few people asked this question, so I'm just going to lump them all together here. What is the smallest level of investment permitted, and can people group together with smaller investors?
Yeah, great question. Generally speaking, our minimum investment is $1 million. But as you remember what I said earlier, we don't just take your money and say we'll let you know when we have a project. We look for a commitment, but we're going to bring you project by project. If I have a project that's only $843,000 to purchase, then that's the minimum investment, right? Our average size project is a megawatt, which is 1,000 kilowatts, and the average size of investment for that is about $3,200,000. That's our average. We've had investments as low as $500,000, but generally speaking, a first-time investor, we would look to $1 million minimum, because we have to go through our process with them and get them comfortable with the documents and essentially educate them on the process, and that requires a lot of bandwidth and resources, and so therefore we wouldn't want to necessarily do that for a smaller project. That's not to say that we haven't had first-time investors at $680,000. We have. We don't have a lot of those projects, but $1 million is the short answer. It is flexible. The next question was about can people come together on their side? They absolutely can. What happens is we don't put ourselves out as tax advisors, and so I put the caveat out that everything that we discuss here you need to validate with your own attorneys, tax attorneys, and tax advisors. But one of the questions that comes into play on investors is, do they have passive income or do they have active income? And if they're passive income, yeah, you can get as many passive investors that can own the company that buys the company we form, our SPV. So we see a lot of times where, let's just call it XYZ Solar Investors acquires the project company, the SPV that we form for Cathedral Catholic, right? And generally speaking, we have a naming convention. They're usually called TA Energy and a number. So we form a company called TA Energy, or acquiring a project from another developer. It may already be named. It could be named the name of the school, solar. So let's just say, Main Street School Solar 1, right? That's the SPV. But that SPV gets acquired by an investor, and usually that investor forms a company to acquire it. Inside that company could be 100 investors. If they're all passive, then there's no issue, because the passive loss rules don't come into play. But if it's active income they're offsetting, there is a 100-hour requirement for an investor to spend on their investment in order to qualify it as active income. And so it makes it more difficult the more investors you have, because it's tough for everyone to put 100 hours in. And the more you get, then you start getting into another level of even a 500-hour requirement. So it's really dependent on the individual investor's tax structure. But I will say that, probably 20% of our investors come in as a group.
Okay, perfect, David. Now, next question. I believe you answered some of this, but again, I do want to make sure all questions are getting asked here. How would you recommend that potential investors get comfortable with passive income limitations, at-risk rules, etc.?
Right. So if there's no leverage, then it's not an issue. That we provide checklists of items to log for your own files and backup in the event that it was ever questioned whether or not you were active in the business. Relatively simple. The more projects you have, the sort of easier that is, because your little holding company, a solar holding company that you may form, and that's where the hours have to be put in. Again, I recommend you get all of this validated with your tax advisors. If you want the leverage and you need it to be, you have passive loss limitation rules, we have a carve out in our documents with the lenders that provides for recourse. But we've really created a very unique structure where the lenders forbeared from seeking the personal guarantee or the guarantee of the investor until a litany of items have already been attempted to pay off the debt. And so we call it sort of a doomsday scenario personal guarantee, which basically, by the letter of the requirements for at-risk capital are met, but it's almost impossible for there ever to be any sizable dollars that would ever have to be recovered from the lender. But we do have that option. It took some time to get that into our systems and then get the lenders comfortable with that, but it is a solution to these passive loss guarantees.
Fantastic. Let's see. Next question. David, can you elaborate on what a PPA is?
Sure. So PPA is an acronym for Power Purchase Agreement. Anybody who starts into the solar industry will quickly realize that there are hundreds of acronyms. The learning curve is pretty steep. We actually have a cheat sheet with all the acronyms in solar. So because you'll hear it, you'll think, oh, what's EPC? What's PPA? So PPA stands for Power Purchase Agreement. It is a service contract between the owner of the system, in this case, the investor, and the off-taker or customer. Off-taker is a solar term for who is using the power on the site. Who's the utility customer is the off-taker. And generally speaking, our PPAs are 25 years. They provide for the rate that the customer will pay for the energy. They're generally written in a way the customer is required to buy all the energy that the system produces during the term of the PPA. And sometimes they're flat, meaning if they start at 18 cents, they don't increase over the 25 years, or they have an escalator. They might start at 15 cents and go up by 2% a year. And when we're out developing projects and talking to customers, we're looking at their needs, their avoided cost of energy. Again, that's ACE is another acronym. Their avoided cost of energy, what their goals are. Are they looking to save more money in the next 5 years or over the next 25 years? If it's a 5-year, real important, we want to try to save as much money as we can, and we generally have an escalator because the rate can start lower. If it's someone saying, really, I want to hedge against future increases and I want to know what my energy is not going to increase over the next 25 years, then we have a flat rate.
Great, thank you. And kind of to add on to that, what happens at the end of the PPA contract?
Yep, great question. So the off-taker customer has 3 options. They can extend either 5 or 10 years. And again, depending on the market, how big the system is, what type of system is, we'll tell them, they can extend at a predetermined rate or an indexed rate against avoided cost. That's option number 1. Option number 2 is they can buy the system at fair market value. They also have the option throughout the PPA at least 2 times, up to 4 times to buy the system. You'll see that sometimes with a nonprofit that can't monetize the tax benefits. So they may have the cash, they may be very successful, but either a nonprofit or a multinational company that doesn't pay U.S. taxes. For example, Amazon, the second largest company in the country, they don't pay any federal taxes. So installing solar and using their capital for solar doesn't make sense because they can't benefit from the tax credit or the depreciation. So they sign PPAs, but they may decide in year 6, after the tax benefits have expired, to buy the system. So they may have an option in year 6 to buy it, year 10, year 20, and certainly at the end of the contract. So that's option 2, is they can buy the system at fair market value. They can either make an offer to us, which is in the case you, and say, okay, we'll pay you X. You say, great. That's an arm's length transaction. That they buy it for that number. Now they're responsible for everything. It's not yours anymore. We don't have to take care of the operations and maintenance or the insurance or any of that. They may hire us to do it and keep the O&M and asset management agreements in place because they're not in the energy business, or they'll just own it and put it in their portfolio. That's option 2. Option 3 is they can ask us to remove it. This almost never happens because at the end of our returns that we put out there are based on removing the system. And so the rate that we charge is based on, so we're planning on removing the system. But if you think of a grocery store, and they're coming at the end of their 20 or 25-year term, and the fair market value of the system is $500,000. And they say to us, we don't want to pay $500,000 for it. We'll pay you $100,000. And we say, no. Then they say, okay, remove it. So if you think about that construct, unless they're changing the use of the building, that solar is good for, there's a useful life of 35 years, but a real life of 50 years if it's properly maintained. The same technology that's in the solar panels today is identical to the technology that was put on, the satellites in 1955 that are still operating. Silicon-based wafer in a solar panel. It's very stable, reliable technology. And so even though there may be higher capacity panels at the time, there may be a different technology, this is still a good power plant. And just like a utility wouldn't, if they were modeling a 20-year natural gas-fired plant, at the end of 20 years, they wouldn't tear down the plant and build a new one because there's a more efficient one. They might go to another site and build a plant, but that plant's still good. Same thing with solar. So generally speaking, they renew. Some of our customers buy it. Very, very few ask us to remove it.
Great. Thank you so much, David. And as we kind of roll here to the end of the hour, if we didn't get to any of your questions, we will be following up with you directly. So that way we make sure David can answer those accordingly. David, is there anything else you'd like to add before we sign off for the day?
No, I guess, I think when you're new to solar investing, it could seem super complicated. What we try to do is really simplify that process. We do the heavy lifting and just bring you an opportunity. So that's first. Second is the statement I made earlier about timing of investment and commitment. I can just tell you from personal experience, it happens every year. People rush at the end of the year to try to find projects, and they're simply not available. And as I said, it's November 12th today. I think we have 2 projects left, and the only and we may or may not push to get those done this year, depending on the tax consequences for our investors. We have plenty of investors that are looking at them, but that's just to give you an example. Here we are in Q4, and of the dozens and dozens of projects we've done this year, we have 2 that can be quote unquote 2020 projects. So that should give you an idea of the importance of making your commitment and being ahead of it. And we'll try to help you by matching you up as best we can.
David, thank you so much for joining us today. And on behalf of everyone at Family Office Networks, to all of our attendees, thank you for logging in. As I mentioned, we will be following up with you, and we hope you have a great day. Thanks so much.
Thanks, everyone. Appreciate it. Look forward to working with you.